Welcome to Talk Tickers, your deep dive into the latest earnings calls.
Good to be here.
Today, we're cracking open REV Group's Q3 fiscal 2025 results. And it's a really fascinating study in contrast, isn't it?
It really is. You've got one part of the business just firing on all cylinders and another facing some, well, pretty significant headwinds.
Exactly. So our mission today is to unpack how these, contrasting forces really drove what was a pretty market-moving quarter.
And figure out what management's planning next and, what it all means for you listening.
Right. So let's kick off with the results snapshot. The headline numbers sent a really clear signal. REV Group delivered, a standout Q3.
No question about it.
Adjusted earnings per share came in at $79.79. That smashed the $0.63 consensus estimate.
Wow, a 25% beat. That's not small potatoes. Right out of the gate, that tells you something's going right operationally.
It really does. Management isn't just meeting expectations. They're, blowing past them.
And that kind of beat, it just signals strong execution, maybe some conservative guidance beforehand, but either way, it definitely builds confidence.
And it wasn't just the bottom line. The revenue story backs it up too. Revenue hit $644.9 million.
Which also handily beat the consensus, right? Right? That was around $616 million.
Yep, $616.2 million was the fact set number. And year over year, reported revenue grew 11.3%.
But didn't they sell off the bus business, so the underlying growth is even stronger?
Exactly. If you factor out that divested business, the growth was actually a much more robust 20.5%. So strong, clean, top-line growth from the ongoing operations.
Okay, so strong EPS, strong revenue.
Yeah.
What about profitability?
Adjusted EBITDA reached $64.1 million. That translates to a pretty solid 9.9% margin.
Nearly 10%. That's healthy.
Yeah.
And I saw something about cash flow that really jumped out.
Oh, yeah. They significantly raised their full-year free cash flow outlook for fiscal 25. They're now projecting between $140 million and $150 million.
That is a big jump. And net cash from operations expected around, $190 million plus for the year?
$190 to $195 million. Yeah, I mean, that kind of cash generation, it just screams financial health, doesn't it?
It absolutely does. It screams stability, flexibility, opportunity, really. A company throwing off that much cash has options, lots of options.
And they still have a huge backlog too, right?
Yeah, substantial, $4.5 billion as of the end of July. That gives them incredible visibility into future revenue.
So it's really no surprise the market reacted positively.
Not at all.
Shares ticked up around the call, but by the end of the day, the stock had rallied significantly, up 12.5% to $58.32.
And it even hit $63.13 a day. Plus, look at the volume.
Right. Trading volume spiked to around 3.67 million shares. That's like 5 times the average.
See, that's not just a casual nod from the market. That's investors saying, okay, we see this, we like this, we're buying into this story. It's a strong vote of confidence.
Definitely. Okay, so let's dive a bit deeper. What actually drove these results? Let's start with what seems like the undeniable growth engine, specialty vehicles.
Yeah, that segment was clearly the star. Fire trucks, ambulances, they just showed continued strong momentum.
But is it just demand, or is something else happening operationally?
Well, that's the key point.
Yeah.
Management specifically talked about sustained gains in manufacturing throughput, quality, and efficiency. This wasn't just about taking more orders.
So they're building better, faster.
Exactly. They mentioned things like lean manufacturing initiatives, workforce training, process innovation, the hard operational stuff that actually makes a difference.
And you can see it in the shipment numbers, right? That's the proof. Fire unit shipments up 11% year over year.
And ambulance units up 7%. That's tangible progress. It shows that operational discipline is paying off.
And they're doubling down on that. They're breaking ground on that new facility expansion in South Dakota.
The Spartan Emergency Response expansion, a $20 million investment.
Why now? What's the strategic goal there?
Well, they're aiming to boost fire apparatus production capacity by 40%, specifically for the custom and semi-custom builds.
40% is huge.
It is. And critically, the target is to get delivery times for those high-performance trucks down to under a year.
Under a year. In that industry, that sounds revolutionary.
It kind of is. Lead times can stretch out for years sometimes. If they can reliably deliver that much faster, it's not just an efficiency gain, it's a massive competitive advantage. It changes the whole dynamic with customers.
And it looks like they're already making progress even before that expansion is done. The specialty vehicle backlog is still huge, $4.28 billion.
Right.
But the number of units in the fire and ambulance backlog actually went down slightly, about 4% sequentially, 6% year over year.
Which might normally make you pause, thinking demand is weakening.
Exactly. But management said, no, that's not it. They attributed it to increased throughput. They're building faster, converting that backlog more effectively.
So they reduced the average delivery time by almost 2 months already.
That's what they said, which is, exactly what you want to see. They're getting trucks out the door.
That backlog reduction driven by throughput, that's a sign of real operational excellence taking hold. Fulfilling orders efficiently, not just taking them.
Okay, so that's one side of REV Group, strong execution, growth engine firing. But then there's the other side of the coin, the RV segment.
Yeah, recreational vehicles. A very different picture over there. Much more challenging.
So what are the main headwinds they're battling?
Well, management pointed to the usual suspects, kind of. Macroeconomic uncertainty hitting demand, dealers still trying to work down their existing inventory levels.
So the whole industry is feeling that pressure.
Pretty much.
Yeah.
But for REV Group specifically, they also called out tariffs on imported luxury vans impacting margins and needing to offer more dealer assistance, basically discounts, on Class B van models.
Ouch. So that hit the bottom line directly?
Yep. RV segment's adjusted EBITDA was down 13.8% year over year because of those factors. It really shows how external pressures can bite, even when other parts of the company are doing great.
Makes you wonder if they feel like they're building fire trucks with one hand and bailing out RVs with the other sometimes.
Maybe a little. But they are taking action. They completed the sale of their Lance camper business.
Right. Streamlining the portfolio. Is that part of a bigger plan?
Seems like it. They called it portfolio reshaping, especially after getting rid of the bus businesses last year. The idea is to focus the RV efforts solely on their Indiana-based motorized RVs.
So narrowing the focus to presumably the more profitable or strategic parts?
That's the idea. It's about optimizing what they can control in a tough market. Pruning the portfolio, focusing on premium motorized units, implementing cost actions, adjusting pricing. They're trying to position that segment for when the cycle turns.
Okay, makes sense. Let's shift to the overall financial footing then, because despite those RV headwinds, the balance sheet looks incredibly strong.
Oh, absolutely. They generated really strong cash flow year to date. Net debt is only $54 million.
Only $54 million. That's remarkably low. And they have cash on hand, too.
Yep, $36 million in cash. So that low net debt position, plus plenty of liquidity under their credit facility, about $247 million available, gives them immense flexibility.
They can weather storms, fund growth, whatever they need, really.
Exactly. It's a very comfortable position to be in.
And they're still returning cash to shareholders. Declared another quarterly dividend, Laura's every 6 cents per share.
Yeah, payable in October. It shows that commitment to a balanced approach, investing for growth, and providing shareholder returns.
Did they talk about their priorities for using that cash?
They did. Pretty clearly laid out. First, reinvest in the business like that Spartan expansion. Second, look for opportunistic share buybacks. Third, maintain that sustainable dividend. And fourth, selectively evaluate M&A if it's accretive.
So a disciplined, multi-pronged strategy, not just sitting on the cash.
Right, using their financial strength strategically.
And speaking of strength, that brings us to the guidance. They raised their full-year fiscal 25 outlook pretty significantly across the board. That was a major positive from the call.
Huge positive. Net sales guidance is now $2.40 billion to $2.45 billion.
And adjusted EBITDA.
Raised to a range of $220 million to $230 million. Think about the midpoint, $225 million. That's a projected 55% increase compared to fiscal 24 pro forma.
Wow, 55%. That shows incredible confidence, doesn't it?
Massive confidence in the operational improvements and that specialty vehicles momentum carrying through.
They also raised adjusted net income, now projected at $127 to $138 million. And that free cash flow number we mentioned earlier.
Bumped up to $140 to $150 million.
Yeah.
When a company raises guidance that broadly top line, bottom line cash flow, it's a really powerful signal of conviction in their outlook.
What about the near term? What are they expecting for Q4 specifically?
For specialty vehicles, they expect low single-digit sequential revenue growth and mid-teens growth compared to last year's Q4, so still solid.
But there was a mention of tariffs hitting that segment too?
Yeah, bit of a headwind there. They anticipate a $5 million to $7 million negative impact from tariffs, specifically on specialty vehicles in Q4.
Is that a one-off?
They expect it to carry into the first half of fiscal 26 as well. But they do have a plan.
How are they managing it?
Through supply chain efforts, trying to resource components differently, and continuing with pricing adjustments. They're not just going to eat the cost, basically.
Okay. And looking further out, when do those benefits from the big Spartan expansion really kick in?
They expect to start seeing some benefits in the back half of fiscal 26, with the full impact materializing in fiscal 27. So it's not immediate, but there's a clear timeline.
And that ties into their long-term goals for delivery times, right? Getting those backlog durations down.
Exactly. Their target is to achieve normalized backlog durations of 6-9 months for ambulances and 9-15 months for fire trucks by the end of fiscal 27.
That sounds incredibly ambitious, like you said earlier.
It is. But achieving that kind of leadership in delivery times would be a game changer. That focus on operational excellence is really core to their whole strategy. It's about building that competitive moat.
Okay, let's pull back and look at the investor context here. The market's reaction was clearly bullish.
Undeniably. That strong rally showed investors believe in the specialty vehicle strategy, believe management can execute, and believe they can manage the portfolio effectively, even with the RV issues.
The positives, the backlog, the throughput gains, the huge guidance raise definitely overshadowed the RV concerns for the market.
You have to look at how RV Group has performed relative to the broader market or its sector.
Yeah, I saw some numbers on that. It's been a massive outperformer, hasn't it?
Hugely. Compared to the industrials ETF, REV Group is up something like 19.6% over 1 month, about 43% over 3 months, and a staggering 85.4% over the past year.
Wow, and XLI itself was basically flat over 1 month, up maybe 5% over 3, and 15% over the year.
Right. So massive outperformance, which, is great, but it also puts pressure on them to keep executing strongly. Investors now expect it.
So what are the key things investors should be watching now? What are the catalysts moving forward?
Well, definitely the ongoing pace of that backlog conversion in fire and ambulance. Are they keeping up the throughput?
Yeah.
Then the progress and eventual benefits from the Spartan ER expansion.
Hitting those higher FY25 targets quarter by quarter, especially for EBITDA and free cash flow.
Absolutely. And then resolving or mitigating those tariff impacts will be important.
Yeah.
Plus, any signals from the upcoming RV industry shows, Hershey, Elkhart, Tampa, about whether demand might be stabilizing or picking up there.
And that long-term vision, becoming the leader in delivery times, achieving those normalized backlog durations, that remains a key strategic pillar to watch.
That focus on operational excellence is the recurring theme, isn't it?
It really is. Okay, now for a segment where we toss around an idea, always remembering this is not financial advice.
Definitely not advice, just an idea to chew on.
So given RV Group's, stellar performance in specialty vehicles, that big expansion plan, the strong backlog, but also acknowledging the RV headwinds and the tariff issues, maybe a more nuanced trade.
Yeah, perhaps something that plays both sides a little, we were thinking. Maybe long-term bull call spread on RV Group itself.
Okay, so betting on continued upside, but capping the risk and the cost. Targeting what, mid-2026 maybe?
Something like that. You're playing for those Spartan expansion benefits to really kick in, for the backlog conversion to continue, maybe even for more free cash flow upside. Banking on the market eventually pricing in those aggressive 2027 targets.
But pairing that with something else.
Right. Pair with maybe a short-term bear put spread on a different RV manufacturer, one that's maybe more purely exposed to the cycle, maybe less on the luxury end.
So capitalizing on the idea that the broader RV market weakness might persist for another quarter or two, using the same macro concerns RV Group highlighted.
Exactly. You're betting those dealer destocking trends and macroeconomic pressures continue for a bit longer across the wider RV space before any potential light from new models later. It acts as kind of a partial hedge.
Letting the core specialty vehicle strength at REV Group be the main potential driver while hedging some of the broader cyclical risk. Interesting.
Outrageous, but plausible, perhaps.
Plausible indeed. Okay, so let's recap. RV Group's Q3. A really strong quarter overall, overwhelmingly driven by specialty vehicles firing on all cylinders, better throughput, strong backlog conversion.
While simultaneously they're working to manage the RV segment through industry headwinds and strategically reshaping that portfolio with the land sale.
Management backed it all up with a significantly raised full-year guidance, emphasizing operational discipline, those key strategic investments like Spartan, and a very healthy balance sheet.
And the market. They clearly loved the story, setting the stock soaring and signaling strong confidence in the execution and direction.
Absolutely. So as always, remember, this discussion is purely for informational purposes. It is definitely not investment advice. Please do your own research and due diligence.
Cool.
But maybe think about this. How often do you see a company navigate such different conditions in its core segments simultaneously, excelling in one while strategically retrenching in another?
It's a complex balancing act.
It really is. And RV Group, this quarter at least, seems to be handling it quite impressively. We hope digging into this gives you some useful perspective on market dynamics. Thanks for joining us for this deep dive into RV Group's Q3.